You're in the Business Insurance Zone with me, Steve Savant, national financial columnist and money color commentator. This week on The Biz, our long-term care series. And on today's show, the policy provisions of long-term care with our special guest, nationally recognized long-term care expert, Stephen Foreman, all here on The Biz.
When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Well, welcome everyone to the Business Insurance Zone. I'm your host, Steve Savant, and we're broadcasting to a nationwide audience of financial planners right here in Fountain Hills, Arizona, home of America's largest fountain. And with me today, long-term care expert and national columnist, Steve Foreman. Hey, Steve.
Hi, Steve.
Welcome to the show. Well,
thank you.
If you've missed our front-end shows, which we pulled from our retail show, One for the Money, why did we do that? We do it every once in a while because we know that a lot of our producers really don't have an entry-level understanding of long-term care, the statistics, some of the basic issues that we talked about yesterday, like indemnification versus reimbursement. Sure. All these things matter. But today I want to talk about what Steve Foreman says are some of the top policy provisions that we need to have a heads up on that we bring to our client and why they're so important.
Okay, sure, we can do that. Well, after we've recap from where we were before, after an agent or a consumer has made a decision about an agency to work with and has looked at a carrier, or ideally that agency has narrowed down the field to the carriers that they're going to be working with, some of the policy provisions that should be reviewed, and fortunately I've got a list with me. One of the top things you're going to want to be looking at is inflation protection. Not only because it can sometimes double the price of the product, but it would be foolhardy to go into a policy that didn't have inflation protection. And in fact, looking back, I see that just a few years ago, as many as 40% of policies did not have inflation protection. And it's a crime. It's a shame. Because 30 years from now, where will those policies be? They'll be worthless. But also, these days, we have what's called partnership, which folks may know is a partnership between private insurance and Medicaid. And the choice of inflation protection is going to determine whether or not your policy is partnership qualified. We're also going to want to look at reimbursement versus cash design.
What about that? We talked about that yesterday, and people debate this all day long, so it's important.
They do. And it's kind of a personal decision, and it doesn't necessarily mean that one is going to be more expensive than another. It's basically just a function of whether or not your bills are going to be submitted and reimbursed by the carrier, or whether or not you're going to show that you're functionally impaired and be paid cash up front. Another one you're going to want to choose is your elimination period. In other words, how long you're going to want to wait until your benefits are payable. In other words, your deductible. And I have very strong feelings on this, and I hope we'll get a chance to cover it. I happen to be a very strong believer that policies should pay from day one, whenever possible. One of there was a study recently that spoke about dissatisfaction, about complaints in the insurance industry. And after it was looked at, it turns out most of the complaints were merely a misunderstanding over the elimination period. It didn't have to do with companies not paying. It was just a misunderstanding at claim time over policyholders or their beneficiaries, their families, not realizing they had to wait 90 days to collect benefits. And everybody likes to save pennies at claim time, but 30 years from now, the question is, they call our offices, the sons and daughters call our offices, and they say, you mean I have to wait how long to get my money? So they want it on day one.
Is there really that much spread between day one and 90 days out? As far as pricing?
You may save $20, $30, $100 per year, but then when you price it out and you look at how much you're going to have to shell out over those first 90 days, and you compare how long it would take you to make up that difference, you may have to live to be 130 before you make up the money you save. So I don't know why it is that something like 90% of policies are still sold with a 90-day elimination period. It's a misunderstanding that people think that Medicare will pick up those first 90 to 100 days.
And it doesn't.
It doesn't. Medicare pays on average about 14 to 24 days when it pays, if you're lucky enough.
What's the next one?
This has to do with restoration of benefits, something that you may choose to buy. It's not an extremely popular benefit, but it's built in a lot of policies, and it's more popular if people buy a short benefit period, like 2 or 3 years.
Do you think people, I mean, I'm just thinking statistically, do you think that's a good thing though?
You know, I hear people that are agents I talk to that are very strong believers in it. The idea is that if you, let's say you're in your 40s or 50s and you suffer a very short-term kind of a claim, a broken hip, a car accident, you rehab for just 90 days or a few months, and let's say you use up $20,000 of your benefit. Okay, you recover, fast forward 30 years, and the long-term claim comes, a Parkinson's, a cognitive impairment that lasted 8 years. It's nice to know that your benefit will have refreshed and be back to square one. You get the full use of it. So, you know, insurance companies kind of debate whether or not it's really used that much, but it doesn't cost that much, or it's built in. One that is extremely popular is spouse shared care. So this is the one that says, if I use up all of my benefits, and for God willing, I still need to use my benefit, I could dip into my spouse's pool.
This is hugely popular.
It's hugely popular, and companies that have often completely revised their portfolios and decide to come out with a new product and strip out everything but the most popular benefits, they will typically at least keep the shared care, because they know, in fact, that it is one of the most popular benefits.
Isn't some of these also, the shared care also lets you do 2 on 1 policy? You get kind of a discount, a shared care at the same time?
It comes in 3 different top varieties, and it will typically include, these are spousal benefits, because they always want to attract couples. It's a very attractive segment.
I totally see that. After the break, we're going to continue explaining the policy provisions of long-term care with national columnist Steve Foreman. And don't forget to enroll at IULUniversity.com for the best training, education, and sales support when it comes to life insurance for retirement income.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.
Hello everyone, I'm Steve Savant, host of the daily internet talk show, The Business Insurance Zone. I've been using Backup Technician for over 20 years for my edutainment workshops, public seminars, and my ultimate resource for my consumer shows. Why? Because it's the best needs analysis and sales support material that addresses almost every financial planning scenario. And now you can test drive Backup Technician absolutely free for the next 30 days. Go to thebiz.tv and click on the BizBlog menu and sign up for the most powerful resource available to financial advisors. Well, welcome back to the Business Insurance Zone. I'm Steve Savant with Steve Foreman. And remember, you can order today's material at thebiz.tv. And just a heads up before moving forward with anything we talk on the show, although we're not really talking anything about taxes today, always consult your tax advisor and your broker-dealer compliance department. And we're explaining some of the policy provisions of long-term care. And with our expert, Steve. Steve, you know, we're going to be giving away, if you say, Steve, go out to our site, thebiz.tv, what are you giving away? We're talking about a lot of things we're talking about now, some of the statistics of long-term care. We're talking about some of the ideas that we're going to have, especially in the next 2 shows. Don't forget tomorrow, if you've just come into this show on Wednesday, you need to go back out to our site, thebiz.tv, and catch Monday and Tuesday's show so you can get up to speed, because you're kind of walking in the middle of the week here, and we want to make sure that your learning experience is really a good one. And remember, tomorrow we're going to be talking about the carriers. I mean, oh my goodness, yes. Some people will be crying after that show. Some of our carriers will be very unhappy, but Steve and I are going to talk about the people that are really the players, and you won't want to miss that. And of course, our controversial show Friday, standalone long-term care or LTC riders on, what's the good? Because there's a debate here on this. But today, let's talk about the next 5 policy provisions, Steve.
Sure. We were talking about some of the major considerations, which riders should you buy, what are built in. I'd like to continue. Another one that's very popular, that these are primarily couples benefits, but that's spouse survivorship. Now this is a provision that says if 2 couples buy a policy together and you keep the policy so long and then one passes away, the other spouse has the policy paid up for life. it's a popular benefit. Some carriers have it built in, some it's a rider, some you cannot have incurred a claim within the first so many years, and some pay without regard to claim. So it can be very popular, particular when the spouses are far apart in age.
Let me just ask for you to stop there. When you say far apart, because I can see, I mean, a lot of people are in second marriages.
Yes.
I've noticed that second marriages seem to have a wider spread in age group.
Happen.
So, is there any? Have they ever restrict you on that, or no?
No.
They just say.
No, I have not seen any kind of restriction on age.
Okay.
It's a popular benefit.
All right.
Spouse waiver premium, this is very typical. It used to be built in almost every couple's benefit. Now it's increasingly less common, but this is very simple. Everyone's familiar with waiver of premium, where you go on claim and they waive your premium. They can't pay you a benefit and ask you to pay back in the other. This one simply says, if I'm on benefit, then my wife's premium is waived at the same time.
Is that pretty standard in the contract? In most of these contracts?
That one can be standard, but I add it in my list of riders because these days more things are a la carte, and for good reason. They're always trying to drive the price of the cost down because consistently affordability is the number one objection to long-term care. So they want to they want to a la carte these prices, and they also don't want single people paying for things that are built in for couples that a single person can never use.
That makes sense.
Next one is limited payment. And these, unfortunately, a lot of these limited payment riders have been discontinued of late because of low interest rates. But if you can find them, I can't tell you how many producers I talk to that say, boy, the best decision I ever made was buying a 10-pay when I could, because we've seen rate increases. And if you bought a 10-pay or a 20-pay, pay to 65, however they are, and after you've made that last payment, there's nothing they can do to come back to you. If they were to file a 190% rate increase, they can't come back to you after you've made that final payment. So, and even if you're in year 8 or 9 and they file a rate increase, they can only impact you in that 8th or 9th year. So a 10-pay, extremely popular if you can find it, also very popular in worksite settings.
Wow.
Finally, I've got 2 more, but return of premium, non-forfeiture. Return of premium is something I'm really going to want to hit on when we talk about the debate between linked benefit, hybrid products, because return of premium, I think, vastly underutilized. This is it's designed to answer the question, what if I never need it? Yeah, what you mean I have to pay all this money and never get my premiums back? Return of premium answers that question. It means you pay for 20, 30 years, and when you pass away, the money does come back to your estate, and it comes back tax-free to the extent you did not take a tax deduction on it. I want to stay away from tax considerations, but return of premium is a great feature. Typically doesn't add that much to the premiums, and it also addresses rate increases. A lot of people don't think about this, because if there were to be a rate increase and they ask you to pay 30% more, people who have return of premium are not as fazed by that, because it's like, I have to pay 30% more. Big deal. I'm still getting that 30% more back. So return of premium is something that more people should consider.
I actually did not look at that the way you just explained it, Steve, as almost a hedge.
It is.
Really, I mean, I like that idea. And you're saying the spread to add this rider is not that much more.
No, I've got a chart in a different article I can show you, and we can talk about that when we talk about linked benefit products, because I think linked benefit products were designed to answer the same question that has already been answered. And
but I got to say, I've heard a lot of LTC speakers in my time, and I don't think they're bringing this out the way you just framed it.
I don't think they are. And then the final one I'm going to bring up, because I believe we're running a little short, and that is immediate benefits. And these are features that are being introduced more and more frequently, and I think they're going to become extremely valuable in the future. When I say immediate benefits, these are wellness benefits that are primarily that are value adds on policies today, and these are things that are caregiver support services, wellness benefits. They're designed to be a win-win, designed to give you something. You say, well, if I don't use it for 30 years, what's tangible for me now? This is something you can use today, and the carrier wins because it keeps you well longer.
Well, remember, you can watch this show and all our shows this week by clicking the red on-demand button right on our homepage at thebiz.tv. Well, that's the Buzz on the Biz for today. Get in the zone, the business insurance zone.
You're listening to the insurance industry's #1 resource for products, planning ideas, carrier information, and interviews you can use. When it comes to life insurance, annuities, long-term care, disability, or group pension plans, we're the news you can use.